Thank you. Morning, everyone. As Hannah says, my name is Phil. I'm the head of corporate finance here at PEM. Today, I'll be covering off an economic update for the UK, a review of some M&A trends that have occurred, and some transactional insights from our perspective here at PEM Corporate Finance. So I've picked this image because I think it captures what's really been going on. And also it links to the actual webinar. That's Turbulence there for those who aren't sure what it is. And I last delivered a webinar back in the summer. And I think it's fair to say that there have been economic ups and downs over the period. Actually, probably more downs than ups, to be fair. It's been a turbulent time, to say the least. See what I did there? I linked the picture with my commentary. So let's move it on. Economic update 1. The political changes have bordered on farcical at times, and the decisions have directly contributed to heightened economic uncertainty. I think everyone can see that, right? It's completely obvious. And nowhere did we see this more than on the 23rd of September, when the then Chancellor of the Exchequer, Kwasi Kwarteng, announced tax cuts worth £45 billion, which were to come into effect in 2026-27. And these tax cuts were completely unfunded. And these announcements threw the market into just turmoil. Kwarteng was promptly replaced by Jeremy Hunt, who reversed 32 billion of Kwarteng's measures, including planned reductions for corporation tax and the basic and additional rates of income tax. My colleague Jan is going to cover all things tax, so that's probably the limit of my tax commentary, to be fair. However, the Office of Budgetary Responsibility, the OBR, suggests that there remains a gap in the government's fiscal plans to the tune of about £72 billion due to inflation weakening the expectations for economic growth. And I'll come to talk about that shortly, as well as the response of the Bank of England to raise interest rates to 3%. And the chart here on the right-hand side shows that in October, when comparing the cost of government borrowing across the G7 group of economies, so that's Japan, Germany, France, Canada, US, Italy, and ourselves in the UK, it's clear that there was a sharp spike in the UK's long-term borrowing costs following the mini budget, and this spike wasn't seen in the other countries. So that's a bit of context there. And unsurprisingly, most economic commentators are suggesting that the UK is either on the way to a recession or may even currently be in one. The chart here is provided by PwC and the ONS, the Office for National Statistics, and they predict that the UK will enter a recession in 2023, largely due to surges in inflation. I mean, we've got inflation rates that's about 10-11% currently, and many predict that are going to increase. And these surges in inflation will have an impact on the cost of living crisis, which will impact all demographic groups. UK inflation outlook remains uncertain. Scarily, PwC are predicting headline inflation could peak as much as 17% next year in the first half of 2023. However, if the government chooses to freeze household energy bills, then this can reduce inflation to about 10 to 13%. So all eyes on the government really in terms of what they're willing to do. The economic outlook changes drastically when focused on Cambridge. And I'm really grateful that we are domiciled in Cambridge. According to the UK Powerhouse study, which was commissioned by lawyers Owen Mitchell and the Centre of Economic and Business Research, as a direct result of overseas investment, an economy rich in services and research-based firms, all of these things mean that Cambridge will remain home to the UK's fastest rate of employment growth. Growth is set to increase year on year by 2.5% in Cambridge by the end of 2023, equating to 7,700 additional jobs, which is fantastic news in my opinion. The report also adds that Cambridge benefits from ongoing investment in the Oxford-Cambridge arc, a region identified as being of global importance for innovation and for business activity. Here, forecasts predict an additional £800 million being added to Cambridge's economic output from Q4 2021 to Q4 2023, resulting in growth of 2.1%. So in terms of an economic update, the wider UK picture is quite gloomy, but because of research, because of outbound investment into this region, you might hear some crash bang and walloping in the background. That's construction on Station Road, which has been commissioned by Apple, the tech giants, who bought a building opposite ours, demolished it to build it again, a purpose-built building. I don't know whether they wanted Apple phones as a direct way to gain entry to that building. That is evidence of, a tech powerhouse investing in Cambridge, and that's replicated by others. We've got Amazon around the corner from us. We've got Microsoft around the corner from us. So, the picture for Cambridge specifically is very, very bright, and long may that continue. Now, turning our attention to M&A trends and the impact of some of these economic factors, and I've focused on the UK and a global picture as opposed to Cambridge centric here. So data sourced by White & Case, a big law firm, and they've got an M&A database, and their analysis focuses on M&A activity within the UK and across the world. And it shows that M&A activity increased from 2017 to 2021, both in the UK and from a global perspective, but that activity has fallen across all areas of the M&A market in 2022. So the chart on the left shows UK M&A activity in terms of transaction sizes, split between mega deals, or 5 billion and above, large deals, 1 billion to 5 billion, upper mid-market deals, sort of 100 million to 999 million, and lower mid-market, which is sort of less than 99 million. And that's very much where we focus at PEM Corporate Finance. We're very much in the low mid-market space. And a chart on the right-hand side shows global activity across the same basis. And you can see that the trend lines have oscillated with a downward trend in FY19, followed by a spike in FY20, and a cooling off FY21 to FY22. And certainly anecdotally, the first half of FY20, PM Corporate Finance saw a real pause on M&A activity, had like a 2-week period. If you cast your minds back to all the lockdown announcements from the government and the real grasping of the reality of the pandemic, nobody was thinking about strategic M&A activity at that point. Everyone was more focused on keeping their businesses above the water. And so there was a real slowing down of activity. But the second half of 2020, then into 2021, when we realized that we could leverage technology to carry on with our transactions, and we could do deals from home in front of our laptops and our computer screens, that just injected a fresh wave of confidence in the M&A market, and deals started to come back to life again. So certainly the second half of our financial year was a lot more busier than the first half. So that's just some anecdotal evidence to overlay with these kind of global and UK findings. And it's a similar story when looking at M&A activity across the last 4 quarters, right? Both in the UK and across the globe. There's been a steady overall decline across the last 4 quarters, both in the UK and globally. And the fall in M&A activity has been fueled by several factors. I spoke about political instability in the UK in terms of the chances of the exchequer changing, and it's like musical chairs in terms of number 10 Downing Street. But that geopolitical instability trend can be seen across the globe, right? Spike in inflationary rates. We're not the only country suffering from higher rates of inflation. Supply chain issues still apparent due to the pandemic hangover. It's no surprise when manufacturing stopped for 18 months, 2 years. And so there was still computer chip shortages and supply chain disruptions that are going to be impacting on M&A activity, unpredictable capital markets with fluctuations in terms of AIM and main market listings, regulatory changes that impact M&A decision makers. It's been a lot. It's been up and down, really. But some sectors have been more active than others. So TMT, we've seen 30% of overall deal values, real estate 13%, and industrials 11%. So there are some sectors that are more active than others. Again, to overlay what we've been seeing, and I'll come to talk about that in a moment, but certainly what we've been seeing in the marketplace, more activity in tech-enabled businesses, where IP is protected in a company, can drive premium and drive M&A activity, where there are people-led, knowledge-led companies. We've seen lots of activity there. Certainly Cambridge-centric sectors, we've seen a lot of activity. What do I mean by that? Tech and tech-enabled, people-led, knowledge-led, agri, food. When agri and tech combine, we helped to sell a business called Yagro, which is agricultural SaaS, software as a service. So I mean, there are pockets of activity, but if you're in leisure, if you're in hospitality, if you're in travel related services, whilst there might have been an uptick in activity coming out of the pandemic and the lockdown, M&A activity hasn't quite matched those same levels of operational activity. So it's quite an interesting market from an M&A perspective, that is for sure. So to finish, what are we in terms of PM Corporate Finance seeing in the market? Well, we've been busy, and it's a contrarian view to some of my analysis. So by way of numbers, a team of 7, we've completed 13 deals so far in 2022. Our pipeline is full. And it's quite an interesting thing. Be careful what you wish for, because we want to be busy in a project-led service line. But when you're busy, it's like, crikey, how do you manage that? As I was driving to work today, I was remixing the Grease song in my head. I've got deals, they're multiplying, and I'm losing control. Only joking. I'm not losing control. The team's fantastic, and without a good team, you're not going to make deals happen. But pipeline's full, and we continue to field work inquiries. Our clients on the sell side are motivated by similar factors to exit, and maybe some of what I'm about to say might resonate with you or your clients in terms of fatigue. A lot of our clients sit in the owner-managed, entrepreneurial, unquoted space, right? And they're fatigued, they're tired. They traded through the austerity measures that were brought around by the last major economic crisis, 2008 to 2010. And then we had Brexit. Do you remember when that was the only thing that all the news channels were talking about between sort of 2015 to 2017, 18, and the referendum happening in 2016? That brought a lot of uncertainty, particularly with our clients who were import and export into mainland Europe, right? And then the pandemic, March 2020, has just knocked a lot of stuffing out of a lot of entrepreneurs, and they're tired, and so they're looking to either sell to family or sell to second tier management. Or if the management aren't ready and the family aren't interested, then they're quite happy to have conversations with trade buyers. And on that topic of trade buyers, we're actively engaged with foreign buyers encouraged by the weak pound, particularly American and mainland Europe. They can spot an opportunity, right? With a weaker pound means that, strategic assets that would have been a lot more expensive 18 months ago are now within their reach from an affordability perspective. And a lot of those companies have lots of dry powder sitting on their balance sheet because they didn't do much during the pandemic other than batten down the hatches and make sure they were ready to trade through. As a team, we've grown. And as I've said before, our pipeline is full. So if you're on this webinar and you're thinking about selling, or you've got clients or contacts who are in that kind of cognitive mental space about strategic options for the future, then please give me a shout. A conversation is free, and I'm happy to share my thoughts with you or with your contacts or your clients. Right, that is enough from me. I'll now hand over to my colleague Jan, who will cover off his perspective from a business tax point of view. Nice one.
Thank you, Philip, for the insight into the economy and M&A activity. I think it's very turbulent times. I think hopefully there is a bit of optimism in the local marketplace that things will carry on growing. I think really in terms of from a tax perspective, I think probably I think that the sequence of events over the last 6 weeks is really been unbelievable. I think having done tax in 20 years, we had a fiscal event on the 23rd of September. And we also, with unfunded tax cuts, no OBR oversights, those were then reversed on the 17th of October. And then we are actually today, I think probably very shortly, going to be hearing from Jeremy Hunt as part of the autumn statement. So I don't think as part of the Q&A, I'll be able to answer just quite quickly in terms of what's going on in terms of the autumn statement, but we are actually hosting a webinar with Matthew Eady and Sancha Norris, partners in the employment tax and private client team, tomorrow, if you want to understand a bit more about any of the tax measures that are about to be announced. So I think in terms of today, I'm really going to focus on the trends at the moment of tax rate rises and really the impact of inflation on taxation is quite severe, as you'll see. And also, given that environment, what you can do at the moment in terms of your business to help grow, minimize tax. And then hopefully the final part of today is going to be a very quick overview of what you should be doing when you get to an exit as well. So in terms of the last 6 weeks, as you can imagine, we've been talking to clients. So on the 23rd of September, we found out about the abolition of the additional rates. So a lot of people within PM were running around sort of saying to clients, this is what you need to think about in terms of profit extraction, maybe defer until the following tax year. That was quickly then reversed. We had to then have those conversations, try and remember who we spoke to and saying, actually, the plans that are about deferring some of the dividends that you might decide to receive, those are no longer going to be viable. And, we are back to the way we were before. In terms of personally, I had a conversation with both UK and overseas clients saying, well, really pleased that we are scrapping the CT rate rise because I think the UK is a very competitive environment. And I think on a couple of occasions for overseas clients, they're saying, well, we were thinking really long and hard about setting up in the UK with a CT rate rise of 25 to 25%. So you can imagine having that conversation again, saying, the optimistic conversation we had, let's put that on hold until we find out a bit more about the autumn statement. So I think that's really, been very difficult 6 weeks trying to advise clients, and I think clients trying to digest all these changes. And that's before we started thinking about inflation. So in terms of what we do know, and I think unless things change, is the corporation tax rate is going to increase from 1st of April 2023 to 25%, and that's for companies with profits over 250,000. We'll still have a small profits rate for companies with taxable profits of below 50,000, and it will be 19%. And we did have 2 rates a few years ago. And what happens is between 50,000 and 250,000, this is where there is a lot of pain because the effective marginal rate is 26.5%. So a lot of planning back a few years ago was, looking at group relief, what you can do to allocate profits within companies to make sure that where you can, really try and avoid the 50,000 to 250,000 band by using some good tax reliefs and planning ahead as well. And those bands are also impacted by the number of associated companies. That was a concept that we had a few years ago. So it's one company controlling the other in a group situation, or 2 companies being controlled by the same person, and that's singular and plural. So if you've got company 1 controlled by Mr. A and B 50-50, and company 2 is controlled 50-50, those 2 companies are associated. So you do have to look at all the various businesses that you have. And you might decide, actually, I want to simplify my structure. Do I need to have those companies and see if I can maybe reduce the associated companies, because it's not just for the rates of corporation tax, but it's also things like quarterly installment payments and so on. The more companies you have, the more you are more likely to get caught by the quarterly installment payments, which will have cash flow implications as well. But, you know, in terms of where does that leave us in terms of 25% rate of corporation tax? At the moment, we are 19%, lowest in the G20. And actually at 25%, we're still going to be lower than a lot of countries. I think we're the lowest in the G7, much lower than Canada, France, US, Australia, Japan, Germany. So I think, you know, the UK is still a competitive marketplace. I think probably a lot of it needs to be managed in terms of uncertainty, in terms of politics and taxation as well. I think, you know, the headline rate of corporation tax is only one thing. We have still probably one of the best places in the world to have a holding company. Dividends received by UK companies are exempt. Dividends paid out by UK companies are exempt from withholding tax, and disposal subsidiaries are also exempt, provided you meet the conditions for the substantial shareholding exemption. So that's why a lot of multinational organisations and companies have their headquarters in the UK. We've got the largest network of double taxation agreements, and we have a lot of reliefs. And that's a conversation I had recently saying, well, look, you know, I had someone from New Zealand saying, you know, the UK in terms of reliefs, really very, very, very advanced and very helpful to businesses. And they're actually having a conversation about setting up a holding company in the UK. I think probably the main thing that's really we've noticed is the tax burden. And I think there was a report by the Institute of Fiscal Studies that basically, I think in terms of taxation to GDP, we are going to be the highest since the Second World War. And I think that was the political battleground that we had between Liz Truss and Jeremy Hunt was, well, you know, taxation's going up, and we need to cut, but you know that was done too quickly, not well, not supported by the OBR, and then we've seen what's happened in the last 6 weeks. I think the best way to do this is to illustrate by some calculations that we did. So I looked at the rates that we had, the thresholds that we had in 2012-13, 10 years ago, and I adjusted those for inflation and compared them with the current rates. And other than the personal allowance, where people are in real terms £952 better off, and this is as of September 2022. So we are still having some significant amounts of inflation. So that's 952 taking into account inflation from April 2012 to September 2022. The high rate threshold in real terms, people are £10,000 worse off. The personal allowance, where you lose your personal allowance by £2, by £1 for every £2 you spend that you have over £100,000. That has not changed for a long time. People are £43,000 worse off than they were in 2012-13. And the additional rate threshold, which was temporarily abolished and then reinstated, that hasn't changed for a long time. And if you adjusted it for inflation, that should be 215,000, but has remained at 150,000 So people are 65,000 pounds worse off. So these are all calculations that I just thought it's probably best to try and plug the numbers and put it into what this looks like. Being accountants, we like numbers, and this hopefully demonstrates how things are at the moment. In terms of pensions, it's no better. Actually, the thresholds have decreased for the annual allowance and lifetime allowance, and the changes are quite drastic. The basic amount has been 3,600, and that hasn't changed for many, many years. And it's the same story for CGT, the capital gains tax exemption. There was quite a lot of rumours that that might be reduced, and that hasn't kept up with inflation. And entrepreneurs relief, business asset disposal relief, back in 2012-13, that was £10 million, and it's now £1 million. So that's quite a significant change, and that came in March 2020. And the VAT registration threshold, I think, has remained the same for the last 3 or 4 years. So I think there's probably a lot more burden on businesses, and I think tax, over the last few years, probably the tax hasn't been such a hot topic, but with CT rates and income tax and so on, I think really focusing on what you can do, planning ahead, looking at what release you're entitled to, is quite an important exercise to go through, which kind of leads me nicely to the next part of today, which is, despite all these rate rises, I think, we have clients that we've advised for many, many years, and, if they take a very proactive approach to tax, actually they put themselves in a very strong position. That sometimes we do have clients come in last minute saying, we're looking to sell the business, and you say, well, have you done this and this? And no, we haven't. And that does make things a bit more complicated from a tax perspective. And in a lot of cases does mean a lot more tax. So I think today, in terms of things that you can do, there's lots of different areas, but I've kind of focused on 3 key value drivers: employees, what you can do from an innovation perspective, and also capital expenditure. And also something that's quite topical as well, tax losses, something that's very valuable when you're making profits in the future and you've got accumulated tax losses because maybe early days you were developing technology. Those tax losses are particularly useful as well, both in terms of sheltering future profits, but also in the context of a disposal. So in terms of employees, I think it's quite cliche, but everyone sort of says employees are probably the most valuable assets of a company. And they're really kind of one of the key value drivers. I think that's something that Philip mentions quite a lot is, when you're looking at the business, you look at the management team, you look at the people, you look at the reliance on the founders and so on. So I think the employees are really an important part of the success of a business. And the government acknowledges that, and for many, many years, they've got various things available, such as share options and enterprise management incentives, which enable people to access lower rates of tax, which are typically reserved to the shareholders and founders. And typically in those situations, what happens is there is an agreement for individuals to acquire shares at a later date based on their current price. And that growth in value is subject to capital gains tax. And if they meet certain conditions as well, they might be eligible for business asset disposal relief and pay tax at 10%. So it's a really powerful recruitment tool. You could give a sign-on bonus. You might pay bonuses through the years, but having share options is something that's much more valuable as long as it's communicated well. It's also a very powerful retention tool, because if things are drafted properly, and I know we've probably got a couple of lawyers here, if people do leave, then they lose that ability to exercise those options and get rewards. So I think it does tie people in. And I think there's been a lot of studies as well to show that where people are tied into the business performs better and the people perform better. And also on top of all of that, in terms of cash and outlay, the company gets a tax deduction as well when those options are exercised. And actually, we had a really interesting transaction in PM Corporate Finance about 10 years ago. We advised on a management buyout. They had a lot of management team who weren't quite ready to have an equity stake. We put an EMI in place. Then we advised on the sale a couple of years ago. And as a result of the growth, they were able to get a CT deduction of £5 million, which in tax terms is £1 million. And they were able to get a repayment of corporation tax for the current year. And they're also able to carry back some of the losses and have a repayment for earlier years as well. So again, there's a lot of benefits there, and something that should seriously be thought about if you're having challenges with recruiting and retaining people. In terms of innovation, intellectual property, I'm sure a lot of people are familiar with R&D tax credits. It's a fantastic relief, but you have to make sure that what you're dealing with you have technological and scientific uncertainties. You have a project to overcome those technological or scientific uncertainties, and you're seeking advance in science and technology, not just for your business, but as a field. And for many years, the relief wasn't really being policed properly by HMRC. HMRC are now looking at R&D tax credits very, very carefully. They've won a number of cases where people have just not done things properly. And it's just make sure you document things properly and seek proper advice. But subject to meeting the conditions, you get an enhanced deduction on the SME scheme of 230% on qualifying expenditure. So for 19% taxpayer paying company, that's equivalent to 43.7% relief. And that's going to be even better when it goes up to 25%. The effective relief is going to be 57.5%. So we are talking about corporation tax rate rises. Things like R&D tax credits are going to become particularly valuable. Things like surrendering losses, it's at 14.5% for loss-making companies. So if you surrender 230%, it's equivalent to 33.35%. So if I spend £100,000, I can get £33,350 back from HMRC. But as I mentioned, because it's such a valuable relief, there's a lot of boutiques that have sprung up over the years, and our advice is really, anyone who is governed by a professional body, ICAW, CTA, ATT, ACCA, this is a tax relief, and you need to make sure you get proper advice. But hopefully that's all the things that you can claim. Then once you have an invention that you can patent, then again, the patent box is becoming a lot more beneficial, except between 10% and 19%. It wasn't particularly, a lot of people were saying, well, that's great, but there is a bit of administrative burden with the relief. But now the difference is between 10% and 25%, then actually the patent box regime is something that's worth looking at if you've got any sales or disposals which have got patents associated to them. And I think this is kind of the things that hopefully the government is doing is okay, we're going to have to hire taxes, but what we want to do is encourage the right kind of behaviours by companies for innovations, for people, and also capital expenditure. At the moment, we've got 130% super deduction. The reason it was given, it was to stop people from deferring capital expenditure to 1st of April 2023, because 130% and 19%. The effective rate of relief is around 25%. And the good news, one of the few things that survived the 23rd of September fiscal event is the annual investment allowance has now permanently been increased to £1 million as well. So again, capital allowances is an important area, quite a complicated area, which I'm not going to go into too much detail today. And finally, something that's probably going to be something worth looking into is tax losses. I think after the last few years with COVID, there's probably quite a lot of losses in companies, and those are very useful. They need to be categorized correctly. They'll shelter future profits or gains against corporation tax. So if you're doing a trading asset disposal, actually those tax losses are very valuable. And also in the case of where there's tax due diligence, sometimes we are brought in last minute to help out with a sale mandate, and tax due diligence brings up some liabilities, then those tax losses can be used to sort of say, well, actually, we have a pot of losses that if you do think there is a risk there, we can offset that against those tax losses. Because in a lot of cases, buyers will not pay for tax losses. They'll say, okay, that's fine, that's great that you've got tax losses, but what we'll do is manage our tax position after we've acquired the company. So I think, trying to argue that those things are valuable to a buyer is something that very rarely works, but they are still very helpful in the context of a deal. So hopefully that's a quick overview of what you can do in terms of in terms of reliefs in helping the business grow. There is also things that you can also think about leading up to an exit. And really, I think you probably have noticed there's a theme there. If you've got an asset sale with the rates of corporation tax going up to 25% trading assets, if someone disposes, a company disposes of assets for, let's say, £1 million gain, then you have corporation tax of 250,000, so that leaves 750,000. And then if you've got an asset sale, then you have to think about how you're going to extract those profits out of the company. You might have income tax on a dividend, or you might wind up the company and get capital treatment as well, subject to lots of different rules. Much easier to do a share sale. The individual shareholder makes a disposal and then qualifies for business asset disposal relief, hopefully and pays tax at 10%. A corporate selling might also get the substantial shareholding exemption. So tax structuring is something that you need to think about well in advance, thinking about what different trades you have, whether you should be splitting those into different companies, whether there should be a group, there should be parallel companies, and that will really help you maximize value on an exit. And then that's one aspect. Then you ideally would like to have cash on day one, but that's rarely the case. You might have cash, deferred cash, you might have earnouts, you might have loan notes, you might have shares in the acquiring company, and all of those things have to be thought about in the context of business asset disposal relief. We do a very detailed session workshop with Philip and corporate finance, and we cover those areas in a bit more detail if you're interested in signing up to those workshops in the future. I think that's hopefully me, and I will pass you on to all of you for a Q&A session. So please let me know if you've got any questions, and Philip as well. Thank you.
Amazing. Thank you, Phil and Jan, for your presentation. So we'll now move on to the Q&A. So we've got a few questions here. So we'll start with the first one. So how do you see M&A activity developing next year, given the economic challenges the UK faces?
Cool. I'll pick that up. Thanks, Hannah. I think from a Cambridge-centric perspective, I can only speak from our vantage point at PEM Corporate Finance. We as I said in the presentation, we've got quite a full pipeline, and our year end is March, and I can envisage a number of those transactions carrying on beyond March into kind of Q2, Q3 calendar year next year. So from my perspective, I see M&A activity continuing and the way it has been, with one eye on the wider economic climate for sure. I think there are things to be mindful of. You need to keep an eye on interest rates, because that has a direct impact on the cost of funding. And if acquirers are reliant on external funding to carry out transactions, then if money is too expensive, they're just not going to do it. Inflation as well needs to be monitored closely, and foreign exchange movements need to be monitored. It's in the advantage point of sellers currently. If we're dealing with foreign buyers with a weaker pound, that they might be opportunistic. But then if the cost of funding is expensive, it doesn't really matter what the pound is doing against the dollar or the yen or whatever. So from my microscopic perspective, we'll continue to be busy. I've got a new member of the team joining at the end of this month, an assistant director coming out of the Big Four. So he's going to be busy from day one. So we're going to be cracking on, but it's certainly important to keep an eye on the wider and economic ramifications. That's for sure.
Great, thanks, Phil. So another question: is now a good time to sell my business?
Yes, and come and speak to me about it. Yeah, I think, let me be measured and balanced here. I think if you are suffering from some of the factors that I mentioned earlier on in terms of fatigue, you've traded through austerity, you've traded through Brexit and the pandemic, and the fire isn't in your belly as it used to be once upon a time, then absolutely, for mental health, for good life balance and all that kind of stuff, exiting is probably a good topic of conversation, right? If you've got a strong second tier management team who have helped you trade through all of those economic choppy waters, and they're keen to get skin in the game, then now might be a good time to have those conversations around wider equity participation. But of course, there are other ways in which you can share the spoils. EMI options are a method that are widely utilised, and my colleague in employment tax, Matthew Eady, will be happy to have a conversation about that. But yeah, I think now is a good time to certainly take stock of the situation, have a look at your strategic options, speak to someone like me, map out a path, and see where it takes you. And actually, we're speaking to a number of clients for whom now is probably not the right time to sell, but are certainly engaging us to carry out a exit strategy review to review their options for exiting in a couple of years' time. So we help to put together a roadmap for box ticking to get them to where they need to be in a couple of years' time. So even if now isn't the right time to sell, now could be the right time to start planning.
Sounds good, thank you. So as a new question that's just come in, would it be a fair assessment that inflation will only be controlled when we get a grip of energy and fuel prices?
Jan, do you want to take that one, and I'll chop in?
Yes, absolutely. I mean, I think in terms of, sorry, I'm trying to look at the budget announcement as we speak, and I think, the impact of inflation is quite clear. And I think at the moment they are freezing income tax thresholds, which, kind of illustrate what the illustration was hopefully, kind of showed how things are looking. And I think there's going to be a higher tax burden. I think that it's been announced the 150,000 additional rate is being reduced to 125,000. So I think a lot inflation is really making everyone poorer. It's increasing the tax receipts, which I think are needed to kind of recover from all the various things that we've had over the last few years. I think, hopefully next year we're talking about a spike to 17%, but I expect, because of the impact that this is going to have a break on the economy, and I expect that inflation will be back under control afterwards. Sorry, hopefully that answers the question in terms of inflation being controlled. And I think, I think the next 3 or 4 months are probably going to be quite painful, but hopefully things will be back under control next year. Thank you.
Brilliant, thanks, Jan. So what do you think is going to happen to business asset disposal relief?
Well, I think at the moment I'm having a look. Nothing's been announced on business asset disposal relief. That was changed in March 2020 from entrepreneurs relief. So it was 10 million down to 1 million. I don't think they're planning on changing that anytime soon. But again, the impact of inflation means that the relief is becoming less and less valuable to entrepreneurs. Great. Any other questions?
Hannah, I think you're muted.
Sorry. There we go, I'm off now. Sorry, Jan, to add to the last question, to add to that, why will putting up interest rates help inflation?
Well, I guess what we're doing is cooling down demand, effectively by increasing inflation, cost of borrowings going up, and effectively that's going to put inflation. It is quite a blunt instrument, but I think it's something that we haven't had to think about for many years. But it's quite a blunt instrument. It's making it more expensive for people to borrow, and hopefully that puts inflation under control as well. So I think given the economic storms that we have with Ukraine, the politics, and confidence as well, people will be spending less, will have less to spend really. So I think that inflation is going to be a very painful spike, but then will be hopefully back under control in the spring, hopefully next year.
Amazing. So we've got one final question. Is there anything I can do now to help my tax position when I sell?
Well, I think probably some of the things I've covered today in terms of making sure that you claim the tax reliefs that you're entitled to. As long as people are proactive with their tax position, looking after their employees, looking at share options, R&D tax credits, capital expenditure, structuring as well. A lot of things can be done quite simply, a few years ahead. And when you get closer to a transaction, trying to split business so that you can get capital disposal, business asset disposal relief, as you can imagine, HMRC become a lot more difficult when it comes to clearances as well. So I think it's something that you do need to review the position on a regular basis. So I think that's the general hopefully theme there.